unexpected lines much more dovish because the inflation forecast has been cut significantly.
Inflation prints for February did turn out to be softer than our projection. We noted that there are several uncertainties around the baseline inflation path, which is why we kept the stance neutral and the rate unchanged. Most notably, investment demand accelerated in the second half of 2017-18, and recent high-frequency indicators point to some further strengthening. Both food grains and horticulture are estimated to have crossed new records. Industrial activity has rebounded and become broad-based, while the services sector has shown resilience and expanded through most of the year.
Aims to tap into the active offshore rupee interest rate swap market to add depth and liquidity to the domestic interest rate swap market. This access will be subject to macro-prudential risk limits.
We have requested the government to amend the schedule, and that's under consideration. In our assessment, also many of the banks are still not prepared to move into India. So we thought that we should defer this by 1 year.
Now we have decided to ring-fence the RBI regulated entities from the risk of dealing with entities associated with virtual currencies.
This is going to be a policy that may be remembered for a very long time for its unexpected dovishness. No, the Reserve Bank governor did not give a rate cut, but the bank practically gave a promise that it may not have to hike rates for a very long time, for the next 1 year, and even longer if its inflation forecast turns out to be what it has given. And how did it give this indication? The Reserve Bank cut the inflation forecast for April to September to 4.7 to 5.1%. That's 50 basis points lower than its forecast of just 2 months back, when the estimates stood at 5.1 to 5.6% CPI for the same April-September period. The central bank also cut its October-March inflation forecast to 4.4%. That's a mild cut from the earlier 4.5 to 4.6% range. This cut has set the stage for a monster rally in bond markets and in banking stocks. Hello and welcome to this Monetary Policy Special. I'm Latha Venkatesh, and joining me on this show are a panel of eminent experts: P.K. Gupta, Managing Director, State Bank of India; A. Prasanna, the Chief Economist at ICICI Securities Primary Dealer; Manish Vadawan of HSBC India; and Jayesh Mehta of Bank of America. Gentlemen, thank you very much indeed for joining me. There is so much for the bond market, so let me go with the bonds, with the bond experts. First to you, Manish. We've already seen a fairly decent rally. What do you think the 10-year, for instance, can do, and how long can the good times last?
Okay, Latha, first of all, I think it has been, as you pointed out, it has been more than expected a dovish policy from RBI, and the fears of, RBI talking about the risk in terms of higher inflation on account of MSP, oil prices, nothing materialized. And I would also say that it's a confluence of a lot of things. It looks like that Q4 was just a bad dream for the banking system in terms of financial markets. I'm talking the bond markets. We have negated nearly all the losses. We have recouped all the losses from 31st December, what the banking system incurred. But I think I would put it like this, that today's policy was a very, very big positive surprise. And the events which have followed in the last 1 week have been, 1, 2, 3. First was the borrowing calendar, which was tweaked by the Government of India. Second was the dispensation given by the Reserve Bank of India in terms of the losses to be carried forward. And I think third was this today. But the speed at which the bonds have rallied is really amazing. It has, taken us also by a bit of surprise. Though it is a happy ending, I would say, because the kind of losses which the banking system was reeling under because of the last quarter, I think 90% of it is recouped. So from that point of view, yes. And how much can this last? The way the next quarter looks like, this April to June, liquidity should be good. Inflation numbers look like benign. The supply is curtailed. And overall the deposit creation, when it happens, there would be demand for bonds also. There has been nothing, no news today on the SLR cut or the LCR dip, etc. All these things put together in terms of good demand for bonds. So this thing may sustain for this quarter quite well.
Okay. Well, let me toss the same question to Jayesh before I get the economist in and the banker. Jayesh, I mean, good, as in, does this go to 7.1? Do the yields go to 7? And what, is it that way for April, September? Or, you peak off at some point before that?
No, I think immediately April, May, June, we are looking at maybe immediately we see 7.1, maybe then, it may retrace back. So immediately it may remain in the range of 7.1, 7.2. Then, of course, we have to see data dependent. I think, while we all say very, very dovish and all that, I would slightly put it, my first reaction was also very dovish policy, but I would slightly put it differently. One can put a different spin in the sense, like till now, the market expectation on inflation expectation versus RBI wasn't much of divergence. I think nobody's surprised about the first half number being reduced, because that is what the market expectation on inflation was. And the second half is just the base effect, which is coming up. Your base came down so dramatically. So I think this is the first, after a long time, both market and RBI is in sync with on inflation expectation. And of course, but unfortunately, it's not a one slam home, one-way direction. Last year, something similar would have happened. I would have said, yeah, we go to 6.5, right? Right now, you have a lot of headwinds which are globally there. Because all the risk factors they have put in, maybe last year or maybe a year and a half back didn't really look like risk factor, but today it does look like risk factor. You have, US rates, you have oil price, you have, a lot of things happening globally, not in India, but a lot of things happening globally, which can disturb the situation. So that's why I think market, eventually it will gradually move down, but I would say May, June, July will be the peak of the yield, somewhat peak of the yield. I think the peak for the year, we have already seen it. So I don't think we're going to that number any time ever, very soon.
All right, no 7.75 anywhere on the horizon. All right, take your point on that. But you go to 7, do you?
Yeah, 7, it can, right? So it's 7, it looks like, okay, it's, it's market, it's liquid, everything is positive, even, a lot of banks were not buying or not participating in market, they have been given dispensation, there's no reason why should not they participate, and I think that will take care of, at least for next 3 months, then we have to see how the data is spent.
Oh, absolutely.
Right?
Absolutely. I've reserved that question for the economist, the data dependency. But first, let me get the banker in. Mr. Gupta, all public sector bank stocks, I said public sector banks because they have a little more of excess SLR than perhaps private sector banks. But they've rallied big time, 5% on the mighty SBI, and then it goes on till 8% for Canara Bank just 10 minutes after the policy was announced. Clearly, the market thinks that you are going to make a lot of gains. Do you think, can you tell us what is the impact on your P&L itself? Big gains?
I think, Latha, I was on your channel 2 days back after that RBI circular came when I talked about the yields moving to 720.
Yes, you did.
I didn't expect them to move to 713 so fast, actually.
Okay.
So, yeah, so in fact, the yields having moved up to 780, there was no economic rationale for that. I think the market had just run up ahead of, anything. There was no real justification for that. So even now, if you look at it, with the policy rate at 6% and your 10-year yield at 713, so I think we still have a very steep yield curve from 1 to 10 year going by, more than 100 basis points. So I think there is still room for it to improve further. Particularly, if you don't really expect that the rates to harden further, I don't see any reason why the yields cannot move below 7% also. On the, generally, typically the first half of the year is normally the time when the credit expansion doesn't happen greatly. But this time the only difference is that, this LOC, LOU ban that has happened actually.
Yes.
So maybe some of the money which was lent by the foreign offices of the banks could get replaced by the domestic lending actually. Okay. So other than that, I think it's going to be quite comfortable. I don't see that, any issues arising out of that.
Okay. And what does it mean to me and my family, so to speak? Will FD rates come down? Or for that matter, will lending rates come down because your competition from the bond market is going to be stiff?
I don't really think that it will lead to any change in the interest rates. I think both on the deposit side as well as on the lending side. Like even when the RBI was raising the rates, the banks did not really tinker with their rates at that point of time because there was enough liquidity available in the market. I think liquidity did tighten up a little bit with the result that some of the banks started raising rates, which forced, in fact, the other banks also to raise rates. I think liquidity is going to remain comfortable. I think at least for the first 6 months, we don't really see the rates moving either way. I don't think that the rates will move significantly lower from where they are. I expect them to remain stable around the current level for at least next 6-8 months, actually.
Okay. Well, now let me get to the economist. Prasanna, the governor began by saying that they're neutral and they are data dependent. So do you think that we can go with this 12-month, at least, no rate hike? Because after all, your end game is 4.4 at the end of 12 months. So no rate hike is a given? Or do you think there are lots of ambushes on the way which can make the data look different?
No, I don't think so. Anyway, we still have an August rate hike view. We are not going to change it. So that's, let me put it up front.
Yep.
Now, why I'm saying it is, see, ultimately 4.4% is a baseline forecast, but if you look at it, they have talked about a lot of risks, and some of those risks have been quantified in the MPR, which I'm guessing not many people in the market anyway read thoroughly. But what we can gather from that is, at least on the MSP, I think RBI has tentatively mentioned that the upside risks due to MSP hikes could be around 50 basis points, which is the lower end of the range we are also looking at. So if we believe that the MSP hikes are coming, and there is no reason not to believe that, and that the government will implement it, and we have to be clear, I think it's a political question as much as an economic question for the government. And since the central government controls a lot of states also, the same party controls, I think it will be a bit more easier for this government to implement a higher MSP across different crops, across states. Now, if that happens, there are two implications. One is the farm prices will go up. The second is there will be a fiscal implication. So both of this will put upside risk to inflation. So I think that 4.4% at this point of time is just a number. That number is going to change definitely. If not by June, definitely by August. So I wouldn't go so far as to say that we are looking at a pause for the next 12 months.
Okay. It's good to have that skepticism in right up front. Gentlemen, I have to take a break. But thereafter, there's another point that the governor made, that output gap is closing. Could not that be a reason for pushing up prices? And as well, the regulatory rules that they announced in terms of pushing back Ind AS and allowing more foreign participation or NRI participation in the FX hedging market. All those questions to our guests in a minute after this break.